Will the Nikkei 225 dropping today when the trend is still a screaming buy? In this video, I give you the exact support zone that must hold, the intraday reversal trigger for a Nikkei 225 long setup, and the breakdown level that would flip the Japan stock market outlook bearish fast. If you're searching for Nikkei 225 technical levels, Nikkei 225 scalp plan, or Japan stock's lower explanation, you're in the right place. Look at the Nikkei 225 right now, down over 600 points on the day, yet every higher time frame you pull up is screaming strong buy. Monthly strong buy. Weekly strong buy. Daily strong buy. But drop down to the 5-hour and the 1-hour, and you've got sell and strong sell signals. That is not a normal pullback. That is a textbook liquidity trap in the making, and the only thing standing between a healthy dip buy and a full-scale long liquidation is one number, 68,434. There is one danger zone and one hidden opportunity right now. I'll show you both. Stay to the end because I'm giving you 3 exact levels you can trade today, complete with stop placement and risk-reward ratios that actually make sense in this volatility regime. Most retail traders are looking at the daily chart, seeing the strong buy tag, and pressing the buy button without a second thought. That is exactly the mistake that gets your position run over. We are going to flip that script right now, instant market verdict. The session bias is a corrective fade inside a structural bull trend. I am not chasing the breakdown, and I am not blindly catching the falling knife. We are fading the intraday weakness only if a precise demand zone holds, and if that zone fails, the bias resets to neutral or even short for a fast momentum leg. Write this number down. If we break 68,434 today with conviction on a 4-hour close, the entire structure resets. That is the line in the sand. Above it, the bull trend is intact and this dip is a reload. Below it, stops get triggered, the long squeeze accelerates, and we are likely visiting 67,287 before you can blink. The herd is positioned heavily long, lulled into comfort by that weekly strong buy stamp. Sentiment data shows trader bias has shifted to the long side in the Nikkei 225, and when everyone is leaning the same way into an overbought condition, the market has a nasty habit of doing the opposite just long enough to clean out weak hands. That's the game. We are going to use it. Now let's walk the charts from top to bottom, and I want you to see what smart money sees. On the weekly time frame, the Nikkei 225 is in a beautiful uptrend. The 200-week moving average down at 56,290 is sloping higher like a ramp. Price is miles above it. The 50-week and 100-week MAs are stacked bullishly. But here's the first warning sign. The weekly stochastic is pinned up at extreme overbought territory, and while that can persist in a strong trend, it also makes the index vulnerable to sharp, sudden air pockets, exactly the kind of 600-point drop we are seeing. Today, the weekly MACD is still positive, no bearish crossover yet, so the big picture remains by the dip. Step down to the daily chart. Price is currently 69,174, and look at the moving averages. The 20-day moving average sits at 68,201, the 50-day at 64,908. Price is still above both, which is why the daily trend is a strong buy. But today's candle is slicing right toward that 20-day MA, and the RSI at 57 has rolled over from the low 60s, losing momentum. This is the first real test of the daily trend in over 2 weeks. And here's what most traders miss. The daily Williams percent are just printed a reading of negative 5.69. That is extreme overbought, and historically when you get a Williams percent of this stretched and then price starts to drop, it is not a one-day event. It often extends for 2 to 4 days of mean reversion before the trend resumes. The market is literally exhaling after a massive rally. That's normal, but it hurts if you bought the top. Now drill down to the 4-hour chart, and this is where the trap gets lethal. We made a higher high earlier this week near the 71,673 resistance, but look at the MACD. The MACD line is rolling over while price was still rising, a classic negative divergence. Buyers were pushing price higher, but momentum was bleeding out underneath. That divergence is now resolving with this drop, and it tells you that this is not just random noise. It's a structured unwind of overbought energy. The 4-hour 20 MA is curling flat, and the 60 MA is still below, so we are in that messy zone where trend followers get chopped up. The critical support on this timeframe is not a single line, it's a zone. The S1 pivot support at 68,434.86 is the floor. That level aligns with a prior structural low from a week ago and a volume node where buyers stepped in aggressively. If price auctions into that zone and holds, you have a high probability bounce. If it slices through, the 4-hour chart flips bearish, and the next magnet is S2 at 67,287. Right below that, the 100-period MA on the 4-hour is rising through 66,500 area, so the downside structure has clear steps. Drop once more to the 60-minute chart, and you'll see why I'm calling this a panic. The 1-hour is a strong sell. Price is below both the 5 MA at 70,166 and the 10 MA at 69,647. The 20 MA on the hourly is 68,201, exactly matching the daily 20 MA. That's a confluence. The hourly CCI is at 30, not yet oversold, which means the sell pressure could still have another leg before a bounce. And the ATR is 1,830 points. That's enormous. It means a single day's range can swallow your stop if you place it tight without respecting volatility. That ATR is your friend and your enemy. It tells you that a move from 69,174 to 68,434 is only about 0.4 ATR, a completely normal intraday swing. Do not panic out of a position just because the numbers look big. The math is what matters. So the technical picture is crystal clear. Higher timeframes bullish, intermediate timeframes overbought and correcting. Short timeframes in control of the downside. The bull case lives or dies at 68. For 34, now let's connect the fundamental driver and cross-linkages because the Nikkei does not trade in a vacuum. Over the last 24 hours, the core news is straightforward. Japan stocks lower at close of trade, Nikkei 225 down 0.81%. The analyst chatter has shifted, with trader bias turning cautious after a relentless rally. But what's really moving the needle is the lack of any fresh hawkish catalyst from the Bank of Japan, combined with a slightly softer tone in US equity futures overnight. The Nikkei is the ultimate risk asset shadow for Asia. When S&P 500 futures dip, the Nikkei tends to amplify that move because of the export sensitivity and the yen carry trade. Right now, US dollar to Japanese yen is holding above the 145 level, which normally provides a tailwind for Japanese equities. The fact that the Nikkei is falling while the yen isn't strengthening dramatically suggests this is pure profit-taking and positioning adjustment, not a macro panic. However, if we start seeing dollar-yen break below 144, that would add a whole new layer of pressure, and then the correlation flips risk off hard. For the next 1 to 2 weeks, my directional lean remains cautiously bullish, but with a heavy condition. As long as 68,434 holds, I expect a grind back toward the pivot at 70,526 and eventually a retest of the 71,673 resistance. If 68,434 fails on a daily closing basis, the lean flips to neutral, and I would not be a buyer until the 67,200 to 67,300 area gets tested and holds. The exact invalidation is a daily close below 68,400. That's your line. Now I need you to engage right here. Do you think the Nikkei holds 68,434 this week and rebounds? Comment yes or no below. I'm tracking consensus and I'll reference the crowd bias in tomorrow's video. Now we get to the part where money is actually made or lost. Most people skip the trade setups and just watch the analysis. That's exactly why they stay stuck. Keep watching, because I'm about to hand you 3 fully structured plans, each with exact entry, stop, targets, and invalidation. And after each one, keep your eyes on the screen. I've built a clean on-screen trade card so you can screenshot it instantly. No confusion. Pure execution. Strategy 1. The sniper. Conservative. This is the high probability dip buy for traders who want confirmation and a wide margin of safety. The trigger is a bullish reversal structure at the 68,434 support zone. We are not trying to catch the exact tick bottom. We wait for price to trade into the 68,500 to 68,434 band, and then we need a 1-hour candle close above 68,600 to show that buyers have stepped in and absorbed the sell pressure. Entry goes at 68,650 on that 1-hour close confirmation. Stop loss sits at 67,950, which is just below the recent swing low that preceded the last impulsive rally, and crucially it is below the psychological 68,000 level where stops cluster. That stop represents a 700-point risk. First, take profit is the pivot point at 70,526, giving you roughly 1,876 points, a risk-reward ratio of 1 to 2.6. Second, take profit stretches to the R1 resistance at 71,673, adding an additional 1,147 points. If you hit the first target, move your stop to break even. This setup is void completely if we get a daily close below 68,434. If that happens, you do not take the sniper entry at all, you stand aside. Now, on screen graphic for the sniper, entry. 68,650, 1H close above 68,600, stop loss, 67,950 take profit 1, 70,526 take profit 2, 71,673 risk, air reward, 1:2.6R to TP1, 1:4.1R full invalidation, void if daily close below 68,434 strategy 2, the active trader, standard. This one is for those who want to participate in a potential bounce but can handle a slightly earlier entry with a momentum shift signal on the 30-minute time frame. The setup is a mean reversion bounce off the 20-day moving average zone. Right now the 20-day MA sits at 68,201. We place a buy limit order at 68,250, just above that moving average, anticipating a wick fill and reversal. You don't need a candle close for this one. The limit order does the work, but you must have the stop in place. Stop loss goes at 67,750, below the intraday liquidity sweep level that would signal the 68,434 support has failed on a spike basis. This is a tighter stop relative to the ATR, so position size accordingly. First target is 69,800, just under the round number 70,000 where sell orders rest. Second target is they. R1 pivot at 71,673. Once first target is hit, trail the stop to 68,800 to lock in a profit and let the runner breathe. This strategy works only if the 1-hour RSI turns up from above 40. If RSI on the 1-hour keeps grinding lower and breaks 35, the mean reversion probability drops sharply and you cancel the limit order, the active trader, the entry. 68,250 limit order stop loss. 67,750 take profit 1, 69,800 take profit 2, 71,673 trailing stop after TP1, move stop to 68,800 invalidation, cancel order if 1H RSI breaks below 35 now. Before I give you the third strategy, type your Nikkei 225 trading range for tomorrow. In the comments right now. Give me a high and a low. I want to see who's aligned with the volatility math. This is where the real learning happens when you commit to a number. Strategy 3, the aggressor, high risk. This is the counter-trend short on a breakdown, only for those who can lose small and manage risk with zero hesitation. The premise is simple. If 68,434 fails, the long liquidation cascade begins. The entry is a sell stop at 68,350. Place to catch the momentum burst once price breaks and closes a 15-minute candle below the 68,434 floor. Stop loss is tight at 69,000, just above today's open area where failed breakdown traders get squeezed. This is a 650-point risk. Take profit 1 is the S2 support at 67,287, giving you 1,063 points, a risk reward of 1 to 1.6. Take profit 2 extends to the S3 confluence at 65,195, where the 50-day moving average is rising. To meet the price, creating a massive support magnet. That second target yields an additional 2,092 points. This setup is for a fast, one-directional move. You do not add to it, you do not marry it. If price breaks 68,434 but immediately reclaims above 68,600 within the same 4-hour candle, the breakdown is a trap and you exit instantly. Warning: shorting a strong bull trend is statistically low probability over a multi-day horizon. This play works only for intraday momentum and must be managed aggressively. The aggressor: high risk entry, 68,350 sell stop, 15-minute close below 68,434, stop loss, 69,000 take profit 1, 67,287 take profit 2, 65,195 risk, reward, 1:1.6R to TP1, 1:4.8R full invalidation. Void if price reclaims 68,600 on 4H close risk management pulse. Never risk more than 1 to 2% per trade. That ATR of 1,830 points means you must adjust your position size so that a stop out is an inconvenience, not a catastrophe. No positions through high-impact news like BOJ announcements or US ISM data. Stops are non-negotiable. This is how you survive to trade the next big move, close and retention loop. The single most critical level for the next session is 68,434. Everything hinges on it. Watch that number like a hawk. Tomorrow's wildcard is the US durable goods release and the final hour of Tokyo Fix. If we get a stronger dollar bid, the Nikkei could easily spike down into our zone right when liquidity thins out, creating a perfect sniper entry. I'll be covering the full breakdown on Bitcoin and the S&P 500 divergence in the next video. That is live now. Tap the end screen to watch it immediately. If this gave you a clear plan for your trading session, smash that like button. Subscribe, hit the bell, and I'll see you in the next one with your levels ready.